much more intangible. So, I mean, I'm sure there's a way you can put a value to it. I'm sure there's people that can do that, but I guess the future is just of value investing is looking more towards trying to price those intangibilities. And something you believe you said earlier, it was trying to find it in here. Okay. Well,
was it focused on the? I guess you need to focus on what type of company it is.
Yeah, you're discussing the Super Investor Index and the 8 you chose, and you made a point to note that while they all came from the same kind of intellectual origin, they had very different, securities, a different diversification. Someone like Mario Gabelli, who's just so heavily weighted in financials, versus someone else like Warren Buffett, who's got the solid stock picks that he has, the boring ones. It's just more, the value investing is just the value fundamentals. So if you keep that same mindset, the patience, the discipline, those are all going to kind of work out for you. So there is still a future for value investing. That is what we use here at the getting my companies mixed up, at the retirement group.
Yeah. Cool.
Mm-hmm. So there is still room for value investing in the world. And, value investing is just, as you said, just the buying the undervalued security. If you have an option to pay for something, at $5, you have the option to pay it at $10, you want the $5. You want to buy things on sale. It goes for the same thing when you're buying groceries and when you're buying your clothes. You're just trying to buy things on sale. So you see, you see Verizon drop $5. Hey, that's a bargain. It's on sale. So value investing is still very apparent.
Yeah. Good. I hope it is.
Yeah.
Cool. Yeah, and another question I was wondering is how does a market moving towards a lot of people doing short-term trading, how does that affect a value investor, or people focusing on technical analysis as well, where it is there's no focus on the actual company?
For one thing, they're providing liquidity, which is good.
Yeah.
It's really good seeing that. You have the speculators and you have the hedgers, so that's one good thing. But, there's always going to be room for the value investing. That's just kind of the classics that never really leave, kind of like the Frank Sinatras, Yeah.
Yeah.
So,
I guess my thought would be it can almost be a good thing because if they don't focus on the company at all, then they can heavily undervalue a company that shouldn't be undervalued because they're just going off numbers.
Yeah. It does nothing but help us. We're trying to go, or at least the value investors, they're trying to go against the herd mentality.
Yeah.
So, having the technical analysis going that way, you definitely enjoy that just because, hey, they're forgetting this, this is down 20% for one day. Yeah, I'm going to go ahead and grab that now.
Yeah.
So, if anything, it kind of helps, it helps the value investor.
Yeah, that's what I would think. Cool. That's all I had.
All right. Well, very good presentation.
Thank you very much.
You were talking to Eric, I believe?
I was, yeah.
Okay, yeah. He will get back to you within the next couple of days with another email, all right?
Okay, thank you so much.
Yeah, good job. Good job, Scott.
Thank you.
Yeah.
All right, have a good day.
You too.
I was really excited because, I got into finance and stock markets when I was in high school. So in ninth grade, I bought The Intelligent Investor by Benjamin Graham and tried to struggle through that in ninth grade. So it hasn't been something I've seen that much in college. So it's nice to see that you guys are doing that, and it's something important because as this presentation will show, it does work. So it gave me an opportunity to bring out the book again and read it and brush up on value investing. So I was excited for it. So here it is. Here's my presentation on super investors and value investing. Let's see. Let's get there. Okay. So what is value investing? Value investing is buying an asset for a discount to its intrinsic value. And so I put Benjamin Graham's book here, his famous book, Security Analysis, and it was him and David Dodd who really made this method of valuing a company and looking at securities. And so that's the big thing is you try to buy something for a discount to what it's actually valued, and that's why it's important, but that's also why it's difficult. Is what is intrinsic value, and that's why he needs to write a whole book about it, is because you have to question how to value something like a bank where there's a lot of intangibles or a lot of off balance sheets, or how do you value an airline where a lot of it is tangible, a lot of it is fixed assets. So that's both the important part and also the difficult part. That's the reason why a lot of people don't do value investing, is because it takes time, it takes a lot of research, and also it's not set in stone on exactly how to do it. And as I go through this presentation and go through the different super investors, they've each found a somewhat different way to go off the fundamental values of this. And so a basic assumption of value investing is that markets are not efficient. If they were, Warren Buffett said he'd be sitting on the side of a road with a tin can asking for money, because there'd be no need for advisors, because all you'd need to do is put your money in a basic index, and you get the same return as everyone else, because you can't beat a market that is efficient. It's also a risk-adverse approach, and he uses the margin of safety, which is the big key to value investing. That's the margin between what the company is selling at, so the price on the market, and what it's valued at. And again, that's the rub, is what's the value of the company. And so it gives these are some of the fundamentals from Graham. Is it gives preference to tangible assets, some of the maybe characteristics but not necessarily the tools for analysis, is that most of the stocks have a low price to earnings. The most time he looks for a high dividend yield and consistent performance throughout the years. Usually the stocks he picks are stocks that have performed well but have fallen out of favor. So people are viewing them differently than they have, so the price lowers, and it gives the value investor a perfect opportunity to purchase the security at a discount. And so, consistent performance is key for this, because you need to buy a security that is valuable, and it has shown it is valuable, but as a contrarian, as the value investors are seeing when it falls out of favor, that it still is valuable. And growth investing is the other side, and it doesn't look so much as to value what the company is worth at this moment, but rather looks at potential growth of the company in the future. So a lot of these things are high return on equity, earnings growth, and all this is forecasted as well for future earnings growth, profit margins, and often they have a high price to earnings. And this is changing a little bit, but generally they have high price to earnings for their stock price, but the trade-off is that people believe that they're going to grow a lot, so they're worth the price. Buffett and value investors would maybe think this is more risky, because they're trying to buy something at a risk, and that's that's something I'll go over in the end is how they lower risk while gaining returns, where growth investing a lot of times is raising the risk by buying something that is potentially overvalued because they believe it's going to have long-term growth. And so it does have the potential for large gains. Also, it's riskier. Often the companies that are doing this are reinvesting rather than paying dividends. So again, it's different than the value investing securities. Yeah. Any questions? Anything so far?
No, I'm kind of saving some questions towards the end. All right.
Okay. Perfect.
So far, real good job.
Thank you. All right. The efficient market hypothesis. Very important. It's what most of academia believes about the markets. A lot of it is theoretical. It seems it doesn't work as much in practice, and has been, frankly, disproven for the most part. So the three main versions of the market efficiency or the efficient market hypothesis are weak, semi-strong, and strong. Strong would be that the stock price reflects all current and past information, all public and private news, and this has been disproven. So the flaw in this is that something like insider trading very easily shows that's not correct because insiders are able to gain information that gives them an edge. Semi-strong would be the same thing minus the private information. Flaw in this is that, something like the housing bubble showed very clearly that that's not necessarily the case, and when investors have all the same public information, they interpret drastically different, or frankly, they interpret it incorrectly. And weak would be that you can't use past prices. All past prices are already in the current price. It also assumes that investors are rational, that they can only obtain normal returns given the risk they're taking, and so trying to beat the market is impossible for consistently beating the market. So the whole thing is that they're informationally efficient. So security prices are what they should be, and there's no buying at a discount. And obviously, this is flawed because there are people, especially the super investors, who are consistently beating the market and have higher return, given the standard or the normally distributed risk that they're taking. And this links with the other most popular theory is the modern portfolio theory. And so this is the staple of this is Markowitz's efficient frontier. And so it's basically that for an expected return, you're going to have an expected risk. Or if you want a certain risk, there's an expected return to get from that. And this is to reach the best possible, you can only do it through diversification and asset allocation. And you can't do it through mispriced assets. So it assumes the same, that markets are efficient. Investors will make the same decisions or the correct decisions based on the information they have. Therefore, you can use statistics as correlation and beta to produce diversification that will produce the best results.